Right, so my name is Yasin and I'm a first year student and I'm going to be teaching economics. So in my previous video I did session 1 to 4, now I'm doing session 4 to 7. Now all these key concepts we're going to cover in this video, so let's get started. So what is GDP? So GDP is the market value of final goods and services produced right in the country. Now you might be thinking what's all these final goods and whatnot. So market value. What is market value? So market value is the price of which customers are buying for a good. Or it's basically the price of a good in a given time, right? And it's final goods and services. Now, the way GDP works is it calculates the market value of the final goods and services, right? So what this means, it's the final user of the good and service. So it's not like let's say things that go into processing. It's more of the final product. So when a shop, for example, sells milk, that's the final product. It's not like the ingredients that go into milk, right? So final product is very, very important. Also very important is produced within a country, right? GDP is only in a country. GNP is residents that are not in the country but are South Africans, for example. But this is GDP, therefore GDP is in the country. Then at a given time period, GDP is usually calculated in a year. So in a year, how many final goods are produced? That is the market value of final goods, right? That's GDP. So GDP measures not only the value of total production, but also the total income and total expenditure. That makes sense, right? When you buy a good, that value of the good, that's technically your expenditure. But also it's technically that income for that business, you see? So if I'm a business, and here you spend, let's say, 10 rand, for you that's a expense, for this business it's an income. So that's how it works. Now summary. So this whole the circular flow of expenditure income is extremely important because you're going to use this to calculate GDP. So I got confused about these arrows and all that thing because it doesn't make so much sense, but I'm gonna try to make it the most sense possible, right? So basically if you picture a money, and where the arrow goes, the money flows. So wherever the arrow goes, the money goes in that direction, and that makes sense, right? So for example, the first one is C, households buy goods and services. So here's C, and then also here's C over here. So the money goes from the households to the firms because they buy the goods and services. You see how it goes? Firms make investments. It's over here, I. Firms make investments, I, you can see it goes over here and goes over there. So investments are like firms make investments. So firms make investments. So what they do over here in the goods market is that they make like infrastructure, roads. So if they build like a factory, they make roads and stuff to transport their products. Or when they invest in the households, they sometimes provide entrepreneurship, skills programs, all those learnerships and whatnot to the households. See, that's investment. That is why it goes from here to there. But also it goes some from the goods market to these firms, right? Because at the end of the day, that investment comes from the households, right? And then G, government buy goods and services. So it makes sense over here. The government, yes, G. The government buys, the money travels from the government to the firms because they buy the stuff from here, right? Government also buys from businesses. And then there's X minus M, you might get confused. Here's X minus M, X minus M. So basically X minus M are your imports. X is exports and M is imports. So exports minus imports. That goes to the businesses. Now I might be asking why is X minus M and not just X or just M, right? So let's see if you're a business here, right? And this is another country. So how do I represent this as another country, right? So another country. If you export, so export means it goes from your business 20 rand worth of goods, but you import 10 rand worth of goods. Technically, what is your profit over here? It's 10 rand, right? You can't say 20 rand goes into your business because when you export 20 rand, technically you're getting that 20 rand. You can't say that because you also imported 10 rand worth of goods. So your net imports or exports are 10 rand. So basically you made 10 rand positive profit, right? If you export 20 rand worth of goods but only import 10 rand, that means you have a surplus. You'll see this in the next chapter video. But yeah, 10 rand. So that is why over here you say X minus M. Because if X was your exports, that means you got the money of 20 rand, but you imported 10 rand, then your net is 10. So X minus M, you say 20 minus 10, which is 10 rand. So technically it's a positive 10 that is going in. If, for example, the 20 rand was import, so you imported more than you export, it'll be 20, it'll be, if this was import, I said, if this was an import, this is the export, 10 minus 20 is minus 10. So minus 10 rand will flow to the businesses. That makes totally sense. So that will reduce the number overall. So that's how it works, right? Households, self-firms, buy. Okay, so this whole Y, see this whole Y thingy majiggy? All of your households buy from firms. No, sorry. Firms offer factors of production. No, wait, households sell and firms buy. Yeah, firms will buy the factors of production. Now, what is factors of production? Land, labor, capital, entrepreneurship. Right? These households, they are workers. So they will sell their workers to the firms. The firm's money will go to the workers in a form of like salary and all that stuff, right? So yeah, government, I told you, government over here buys goods and services from the firm. The rest of the world, there we go, net exports, I told you, X minus M. X stands for exports, here we go. And then M stands for imports. Now, GDP, okay, so this is very, very important. 3 ways of calculating GDP. For the first, there are 2 common ways, it will come in a test. Expenditure method, income method, right? Expenditure method is very, very easy. Now, I might be thinking how to memorize all this thing over here. Can you see over here, CGI X minus M are literally all here on the right. Where is C? C is over here. Also C is over here. Where is G? G is over here. Also G is over here. I is over here. Also I is over here. X minus M is here, over here. So literally everything on the right over here, if you just memorize the diagram, is your total expenditure approach when calculating GDP. So you just sum up all these numbers. Obviously, if there were numbers there, you sum it up, done. Total income approach is only the Y. So literally, it's literally everything that goes here. So basically, all the income the household gets. So all the income will be like your rent, interest, if the household invests in the business, all that. But right now, the expenditure approach is very, very easy. C, that means the consumer invest money in the business, so they buy products and whatnot. Government invest money in the firms, buy from the firms. Investment, the firms invest in the goods market or businesses, or it can be the other way around. People can invest in the firms, and then X minus M is exports minus imports. And then income method is just these calculation, whatever the blue arrow is. So yeah, so when they give you the numbers, you just have to calculate everything now, right? Now, why domestic and why gross? Now, domestic product within a country contrasts with national product value of goods produced anywhere in the world by residents. Okay, so domestic, okay. So GDP, gross domestic product, is only within South Africa. NP, gross national product, is residents out from the country. For example, if we are in South Africa, so we can draw South Africa. Okay, that's not South Africa. If we can draw South Africa, let's say South Africa produces GDP worth of 1 million worth of goods. But then one South African over here went to China and he produces 10 rand worth of goods or dollars worth of goods. Him will be included in the GDP if this is GNP. If you're just GDP, we only look at South Africa residents. No, sorry, we only look at within South Africa. But because this person is a resident of South Africa but not in the country, GNP will calculate his thing. Right? So gross means subtracting capital depreciation, decrease in firms the capital results in obsolescence. So net GDP would be accounting for depreciation. Okay, so GDP, when you look at this figure, doesn't include depreciation. So accounting, you'll know what's depreciation. Depreciation is like when your capital goods, you know, might ask what's capital goods. Very important. Capital goods are all goods that you use in your business to manufacture other goods. Your equipment, your machine, your all those things are capital goods, right? GDP will not take out that expense. Depreciation in accounting words is actually an expense. So GDP will not take that as an expense, you see. So it'll not take that. But NDP, net domestic product, net, will take into consideration depreciation. For example, if the business made 1 million rand worth of goods, but its machinery depreciated 100,000 rand, NDP would be what? 900,000. GDP would be a million. So NDP takes into consideration depreciation because that's actually technically an expense. Yeah. So I told you there's two ways of calculating GDP. Three ways, but the two common ways are this approach. The production approach is the easiest. You just take, I think sales or whatever, minus cost of sales. Okay, so first we'll go back to that one now, the production method. But again, this method is what? The expenditure approach, right? Or everything on the right. So this is C, this is I, this is G, X minus M. And then obviously this is your answer. If you calculate all this is your answer, your GDP. Easy, right? Now you see how over here net exports of goods and services is minus 18. This means that they imported more than they exported. You see, this is why you have the X minus M kind of thingy. To know whether you exported in profit or you exported in a loss. You export more than import is profit, is plus. The other way around is a minus, right? Income approach, right? So you know how I showed you this thing with it? This here. I told you all this over here is the income. So you're calculating all the income the households get. So what are all the components of this income over here? So there we go. So this is all the income on that Y line, the blue line basically, right? So the wages for labor, interest for capital, rent for land, profit for interest and administration. This is all the income that's calculated, right? So the national income and production accounts are divided into two big categories. So basically, income as a whole is divided into two categories, two types of income. Compensation of employees are like your salaries, your wages, your benefits, your UIF, all those things, right? Net operating surplus is basically your net interest. So what is net interest means? If I am a person who invested in a fixed deposit, I got 100 rand interest. But I also took out a loan and I had to pay the interest, which is interest expense of 500. So what I said, so my interest is let's say my interest I got from my fixed deposit is 1,000 rand. The interest I have to pay to the loan is 600. My 400 rand will be my net interest. That means my profit, 400 rand. So that is what net interest is. Because a person will either get a loan or invest in a fixed deposit. Interest might be an income or might be an expense. That is why you say net interest to get what will it be, right? Yeah. Then rental income is income, dividends is an income, and proprietary is income. That's entrepreneurship. So when a person owns a business, self-employment, right? Compensation of employees, I told you, payment for labor, services, salary, wages, all that. Net interest, interest that a household receive on loans, they grant minus the interest household pay on borrowings, I told you. So you get let's say 8 rand interest from a fixed deposit, but you have to pay 2 rand on interest you got from a loan. 8 minus 2 is 6 rand, so your net interest is 6 rand. Rental income, you obviously offer rental to people and stuff, so that's a form of income. Dividends, you invest in businesses, you get shares, dividends. Proprietary is income, owned by a business, self-employment, right? You own a business by yourself. All factors over here are net income, right? So this is literally what goes into the GDP income approach. But here's the catch. So all these incomes over here, you must understand, they're manipulated, right? So you know how before, if you are working in a business, your income is taxed, right? So you have to pay it's called deductions. You have to pay deductions, all that. Also, government gives a lot of subsidies to businesses. So that's like a problem, right? We need to take all that out, reverse that. So because it happened while everyone is working, we need to reverse it. So the way we reverse it, so all this right now, all this we got right now, we got it in our calculation. But all that we added, we have to add the taxes minus subsidies, and that finally will give you our GDP. So you see, so you add all these numbers together, you plus the indirect tax minus the subsidies, that's how you get your GDP for the income approach, right? And this will give you a net GDP, right? If you want gross GDP, oh wait, this is, yeah, wait, we're still over here. After you do this, you get net domestic income, right? So not net domestic income is like net GDP basically. I told you net GDP don't it's there's no depreciation inside it, right? But GDP, there's depreciation inside of it. So you need to add add depreciation. So basically add all this together, and then you do three things after: add taxes minus subsidies and add depreciation. You get your final GDP. So over here it's the same thing, right? So all these over here are income. I told you on the first page, income. But you minus indirect tax, actually you plus indirect taxes, you minus indirect taxes, and you add depreciation, and there we go, your GDP. You see how easy it is? So put all the income plus the taxes minus subsidies plus depreciation will always be like this, and you get your figure. So the income approach has three extra things over here which you need to identify, and that's how you do it, right? Don't worry about this I don't know, but basically that word, right? That's just a way of like economists doing that, so like they can like reduce error or whatnot. Okay, they're just throwing numbers in just because the balance sheet never balance, but yeah, it's fine. So the income approach, yeah, see, there's income, you add the taxes minus subsidies and add depreciation, and there we go, GDP. Now can measure GDP using output product. Okay, so this is the value approach. Value approach is very easy, it's the easiest. So let's say you're working out GDP for the country, right? But obviously there's so many things, businesses in the country. But let's say hypothetically, in this one country, there's two businesses. I'm calculating GDP for this whole country, right? The way we do this is very simple. What we're going to do is this. What is less intermediate goods? Intermediate goods are like cost of sales. So you know how in your income statement you have sales and cost of sales, gross profit. Gross profit is technically your GDP. So like intermediate goods are goods that goes into production. So if I'm manufacturing, let's say a milkshake, the milk is a intermediate good. It goes into the production of that, right? So 100 Rand minus cost of sale, which is 0 in this case, which is 100 Rand, plus for this business 200 Rand minus the cost of sale, which is 100 Rand. So 100 plus 100 is 100, so it equals to 200. You get it? 100 minus 0 is 100, but also we need to consider that business because there's two businesses in the country. 200 minus 100 is 100, that is 200. So literally taking your gross profit plus the gross profit of all businesses in South Africa. That's literally what the production approach is, one of the easiest approach ever. Let's see, next. Why is it not going next? Okay, gross national product. So the total value of, total value of final goods and services turned into a given period by means of production owned by a country's residents. I told you, right? So this people, right, they can be abroad. So they are South Africans, right? But they're not in South Africa currently. But they're like in China and they own a business there, but they're residents. So whatever they're earning over there, we calculate it in our GDP. So, but it won't be longer called GDP, it'll call gross national GNP. GNP calculates those people that are residents of South Africa but not in the country, not within the country. GDP is only within the country, right? So yeah. So as you can see here, GDP is over here. So all these, if you add it, you get GDP. If you add the income from the people abroad, you get your GDP. I mean GDP, which is over here, right? Your total. Now nominal GDP and real GDP. Very important, right? I discussed this in the previous video. Did I? Yeah, I think so. Nominal is also called normal GDP, but we call it nominal GDP and real GDP. So I told you, nominal GDP versus real GDP is completely different, right? So the way you want to understand it, let me just draw it because you'll understand it better. So this is quantity and then price. So let's say 20 products, 10 Rand, 50 products, 15 Rand. Let me just say 20 Rand. Right. So this is, let's say, milk, this is sugar, right? Right. So what will be the GDP if we use nominal GDP? Normal GDP, all we say is this. You produce 20 milks and the price is 10 Rand each. 20 times 10 is 200 plus 50 quantities of sugar you produce is solely for 20 Rand. 50 times 20, that's 1,000. Nominal GDP is 1,000. 1,000, right? 1,200. Right. So that's how you calculate nominal GDP. But that's not realistic. Why? These are two different years, right? So I forgot to tell you. This is like 2015. This is 2020. These are two different years. And in these 2 years, we had inflation. So the price went up. So we can't technically use this price. So real GDP will say, hold on, why not use this year's price? So to calculate GDP now, I will say same 10 times 10 Rand. 20 times 10 Rand, which is 200 plus. We won't say 50 times 20, we'll say 50 times the price of this base year. 50 times 10, which is 500. So the GDP is 700. And this makes more sense here because there's no inflation. So real GDP calculates the price on the base year. For our South Africa, base year is 2010. So for example, if we manufacture now in 2024 100,000 Rand worth of bread, we'll see 100,000 Rand, 100,000 times the price of bread in 2010. That will be used in our GDP, real GDP, right? Not the price it's currently now because it's inflation. Oh, they did it over here actually. So I want you to look at this. So the base year was 2010, right? So 2014. So these are 2014. Just that this is nominal and this is real GDP, right? So you see how nominal GDP, they took 4 times 50. They're not taking the price for like this year, 2010. 2 times 200, 2 times 400. But see how this price over here matches this price over here? They're both the same. See? So when you manufacture goods using the price of this year, the base year. And that's how you calculate your real GDP. Limitations of real GDP. So there's a lot of different harmful things of real GDP. Economists use real GDP to main purposes, compare standard of living, across countries. So it's a good thing to use to see how good the standard of living in the country is. So one method of calculating standard of living is your GDP per person, right? GDP per person is simple. Real GDP divided by the population, right? If your real GDP is 50 million and if you have 20 million residents, 50 million divided by 20 million, right? That'll give per person. The higher the better, that means more people have a higher standard of living, right? The growth of potential per person. So as you can see, potential GDP per person, real GDP per person. Potential GDP per person is what that country could have, but obviously they can't, right? If they put all the resources together, they can be the black line, but they can't. So that is why they go like up, down, up, down, up, down, up, down. They fluctuate constantly. So this is normal, right? Real GDP, relative GDP. At the end of the day, these real GDP and this GDP, valued at the same price. So if you can, looking at two different countries, right? America, South Africa, you will realize one will be in dollars and one will be in rands. Now you can't look at those two graphs and compare because they're not in the same currency. So you have to put it in the same currency to actually compare. The limitation of real GDP. So the limitation of real GDP are the disadvantage of real GDP. Why is it bad? A lot of people produce stuff at home. We got a lot of home businesses now, but real GDP don't account for that, right? Underground economic activity, drugs, it doesn't account for drugs. I mean, drugs are like millions, billions of rands, but they don't account for it. Health and life expectancy, leisure time, environment quality, all this GDP don't approach, right? Real GDP. Bottom line, the influences are omitted from real GDP. So all these things which you can't put in GDP over here are bad because it could be large difference and it could display something more better. Developing countries, so developing countries have a large amount of household production. I mean, this is obvious, right? Farming, subsistence farming, all that it won't calculate. Despite the limitations, real GDP remains the most widely used calculations. So in economics, everything we do, although it's not the best, this is the best right now. And that's it for today.